Hello traders and welcome to a new video. Today I'm very excited as we are going to discuss one of my favorite topics. For those who know me, knows that it's obviously trend lines. I use trend lines for almost everything, to make market structure, to identify the overall trend, to find key rejection levels on daily and weekly time frames, and of course for entry. As you all know, trend lines are non-horizontal support and resistance, and they are perhaps the most used and abused tool in modern technical analysis, as they look good on your chart. However, trend lines are very subjective. For example, if you give two traders the same chart, same time frame, and ask them to each draw a trend line, you will probably see two very different results. That's exactly why we created RichTL indicator to help traders draw objective or rule-based trend lines without second guessing, because as you know, subjectivity is a big killer when it comes to trading. Anyway, today we are not going to talk about RichTL, as we already posted two videos on our channel explaining its importance and how to use it to draw rule-based trend lines, patterns, support and resistance, and even our customized strategies. In this video, we are going to discuss classic trend lines. First, we will list the most common trend lines lies and misconceptions, and then we'll go over its types, characteristics, advantages, and the proper way to draw trend lines. So let's get started. The first rule to draw a valid trend line is to connect at least 3 swings or 3 points. Why 3? Because 2 points are not enough. It may be random. So if you look around you, you can draw an infinite number of lines between you and the door, chair, laptop, cup, just everything. Same logic applies here. If you want to draw a trend line, let's say from this point, you can draw plenty 2 swing trend lines. You can draw this one, here as well, and here. All these trend lines are not valid as they connect only 2 swings. Let's delete it and try to draw from another point. You can draw this one, which is not valid. You can draw, this one, which is not valid, only 1, 2. The only 3 swings valid trend line on this chart is this one. First swing, second swing, and third swing. So here is our only valid trend line for this chart. And in case you are wondering why this trend line is not valid, even though it's connecting 1, 2, 3, 4, 5 touches, as mentioned before, our trend lines has to connect at least 3 swings and not candles. So in this case, all this area, all these touches are considered as 1 swing only. So this trend line is connecting only 2 swings. That's our first one, and that's our second swing. So it's not valid. Let's make one more example. This trend line here is not valid, even though it's connecting so many touches. Let's say this one. So 1, 2, 3, 4, 5, 6. So traders consider this trend line as a very strong one. However, it's not valid since all this area here belongs to the same swing. So that's our first swing and that's our second swing, and then it got broken. So this trend line is not valid. In brief, rule number 1, we only draw trend lines that connect at least 3 swings, not candles. Rule number 2, the distance between the swings has to be equidistant or symmetrical. Let's take an example. Here we have a valid trend line 1, 2, 3. And just a quick reminder, the 3 swings used to draw our trend line should not have a candle close on the other side of the trend line. For example, we can't draw this trend line like this as it would be already broken. So wicks are tolerated but not candle close. And as per our second rule, the distance between the swings has to be symmetrical. In other words, the distance between the first swing and second swing has to be almost equal, at least visually, to the distance between the second swing and third swing, which is not the case for this trend line. As you can see, the distance between the first and second swing is much bigger than the distance between the second and third swing. So even though this trend line is connecting 3 swings, it's not valid because the swings are not symmetrical. Since our trend line is not valid, let's delete it and look for a better one. I can see that we can draw this trend line here, first swing, second swing, and third swing, and the distance between the swing is almost visually symmetrical. So that's a typical 3 swings valid trend line. Let's take one last example. This trend line here is not valid, even though it's connecting so many swings, 1, 2, 3, and 4, because price didn't form a new swing around here for the distance between the swings to be symmetrical. Even if we make it like this, 1, 2, 3, 4, it wouldn't be valid as well, as the distance between the swings is not symmetrical. The distance between this swing and this swing is much bigger than the distance between these two swings. Rule number 3, the angle of the trend line has to be below 40 degrees. So let's delete our old trend lines and take an example. Here we go. Here we have a valid trend line, 1, 2, and 3. This trend line is valid as the distance between the first swing and second swing is almost equal to the distance between the second swing and third swing. And if we zoom into lower time frames, we can see that we don't have a candle close below our trend line. That's our first swing, second swing, and third swing. To check its angle, we can use this feature here, lines, trend line by angle. Our trend line's angle is 21.5, which is below 40, so it's a typical valid trend line, and any angle above 40 degrees is considered steep and therefore not valid. So let's take an example. If we zoom in, we have this trend line here, 1, 2, 3. It's a valid trend line since it has 3 swings, 1, 2, 3. However, if we check its angle, we can see that it's above 40. It's around 64.2, which is considered steep. Therefore, our trend line is not valid. Rule number 4, just like support and resistance, trend lines are zones on our charts and not lines. Another mistake traders usually make is that they enter at the trendline breakout immediately, which is completely wrong because, as mentioned, trend lines are zones and not laser lines. But don't worry, I will share with you 2 tricks from my customized strategies that will help you avoid false breakouts and treat trend lines as zones. The first trick is to literally treat trend lines as zones. If we zoom in, we can see that we are connecting the wicks, as you can see here and here and here. So the first trick is to treat trend lines as zones. We make an offset for the trend line to cover the previous wicks, and then we'll make an offset to the downside as well, like this. Let's make it a bit bigger. So this way would be treating trend line as zones, as you can see here, and will only enter a sell in this case when the entire zone is broken downwards. The second trick, which I personally prefer and use with my students, is to wait for an extra confirmation for the break below the last swing that forms around our trend line. So we draw it like a zone, and that's exactly why we call it the last swing standing. In this case, we will not need the offset, as we will not enter on the trend line immediately, and we'll wait for a momentum candle close below our last swing to sell this one in this case. Rule number 5, you should not enter solely on a trendline break, since it's not a standalone strategy and definitely not foolproof. Just like any chart tool, trend lines act as one confluence in your trading plan, and you should only enter if you have other confluences for extra confirmation, like divergence, supply and demand, or key rejection levels from higher time frames. Which brings us to our next rule. Rule number 6, on H4, H1 and lower time frames, trend lines act as trigger. We wait for a break above or below our last swing standing to buy or sell. However, on daily, weekly and monthly time frame, trend lines act as rejection or overall direction, not for entry. Let me give you an example. Let's zoom out to weekly time frame. First of all, we can draw our trend lines on daily, weekly and monthly using 2 swings only, since we are not going to use these trend lines as entry, as trigger, but only for an overall direction. From weekly perspective, price is overall bearish, making lower lows and lower highs, and we can draw this trend line from this swing and this swing. So starting here, we can start to look for sell setups on lower time frames, as price approaches our upper red trend line. Let's make it in blue. And as mentioned, our trend line from weekly acts as key rejection level. So let's zoom into lower time frames and look for sell setups around it. Let's zoom into H4. We already covered this one, so let's scroll back and look for the previous ones. Here's our first one, and we will be looking for sell opportunities. Here's an objective trend line, 1, 2, 3, and the distance between the swings is almost visually symmetrical. Here we go. That's our last swing standing, and our entry would be a candle close below our last swing standing. And as usual, our stop loss goes on the last swing from the other side. Let's look for the other one. Here we go. If we zoom out, we can see that we also have a head and shoulders pattern here. Head, left shoulder and right shoulder. And here's our neckline. We also have a valid trend line, 1, 2, and 3. Our entry would be a candle close below our neckline and our stop loss above the right shoulder. Last but not least, rule number 7, trend line equal rejection, not continuation, no matter if the trend line is on weekly, daily, H4 or any time frame. Let me explain. On weekly time frame, we had this trend line here. Let's delete our vertical lines and these ones as well. We also have this trend line. Since it's from weekly time frame, we can draw it from 2 swings only, so 1, 2. By trend line equal rejection, not continuation, we mean that if we have a falling trend line, then we are looking for buy opportunities. We are waiting for a momentum candle close above its last swing standing to buy this one. Even if our falling trend line is below price, acting as support. It's not like an horizontal support that after it's broken downward, it becomes resistance. Falling trend lines acts as rejection. We only look for buy opportunities around it and not sell. That's a mistake traders usually make. When a falling trend line is broken downward, think about it like it's getting into an oversold zone to get more liquidity to be able to push price higher. And the same thing goes for rising trend lines. If you have a rising trend line, then we are looking for sell opportunities only. So here's our last swing standing. We even have a head and shoulders pattern here. Even if the rising trend line is above price, we don't look for buy opportunities if price breaks it upward. It's like it's getting into an overbought area for the sellers to get more liquidity to be able to push price lower more aggressively. So long story short, from weekly time frame, if we have a falling trend line, then we'll be looking for objective sell setups around it. Unless price breaks it upwards above its last swing standing, then it would be overall bullish. And if we have a falling trend line below price, then we are only interested in buy opportunities around it. We will not sell if price breaks it downwards. And if we have a rising trend line, we will be looking for buy setups on lower time frames. Unless price breaks it downwards, then it would be overall bearish. And if we have a rising trend line above price, then we are only interested in selling this pair. That's it for trend lines. Hope you like it and make good use of it. If you have any questions or if you like me to talk about a specific topic, feel free to comment in the section below. See you on the next video.